So I recently made a video about investing in the S&P 500, and some comments and folks who have messaged me have basically indicated that the risk of potential overconcentration in the S&P 500 is vastly overshadowed by the possibility of missing out on the returns that the S&P 500 can provide. Now, I want to make it clear that I'm not arguing in favor of being out of the market completely. In fact, I think you should have a bulk of your assets in the market, especially if you're young and looking for aggressive growth. That said, I think overconcentration specifically in the S&P 500 should be avoided, and you can allocate resources elsewhere and still get the same rate of return. So here's the thing. I don't think there's strong fundamental analysis to support the S&P 500's continued aggressive growth other than the historical analysis that it's done really well over the last few years, and the fact that it's everyone's de facto retirement plan. A lot of capital gets deployed into the S&P 500 simply because so many indexes track it. But the underlying fundamentals of these businesses and the macroeconomic environment as a whole, I don't believe really provides strong evidence to this aggressive growth that so many investors seem to expect moving forward. Allow me to explain. Firstly, I think the market has already baked in some mild interest rate cuts, and the increase in money supply, I think, will continue to be moderate at best, but I don't think we're going to have this aggressive growth in M2 money supply or money supply in general. I also believe a lot of growth in earnings of the underlying companies is, again, baked into the market. The S&P 500 is sentiment-based, and I think that sentiment is already baked into the valuations that we're seeing today. That said, I'm not necessarily 100% convinced that we're going to see a massive market correction or that the market will even go flat, specifically the S&P 500. That said, I do think there is some prudence in having some diversification outside of the S&P 500 and allocating resources towards other assets that can perform at the same level without the concentration risk associated with being in the top 10 companies in the United States, with what I mentioned earlier being massive potential overvaluations. I think allocating some of your resources towards mid and small cap funds could be extremely prudent. And if you have the sophistication to, putting some money towards private assets or private placements could also be a great way to get yield, high returns without the overconcentration in the S&P 500 and the risk that comes with the potential of a correction if I'm correct and these assets are in fact overvalued. That said, this isn't financial advice, but I would definitely recommend taking a look at your own portfolio and determining for yourself how much of your portfolio is actually allocated towards the top 10 companies in the United States. Again, not that those are bad investments, but I think the prudent investor can always consider the fact that some diversification could be prudent, and protecting yourself from the potential of a market correction is, again, always a smart move.